Financial statements provides little knowledge unless you can use the financial statements to determine potential profitability for the business. As an entrepreneur, you'll find that there's often not much difference between your financial statements, your personal financial statements, or the financial statements of your business in the eyes of a potential financial institution. So it is important that we understand what these financial statements are telling us in order to make good decisions that can help grow the business, expand the business, continue the business to be sustainable, to provide us with some level of income. And if in the future I'm interested in going to a bank and asking them for additional money in order to expand, or if I'm looking to establish a line of credit to buy additional supplies, or I'm looking for a credit card to be issued in the name of the business, then it becomes really important to understand what is it that my financial statements, what story do they tell? It's also important to use financial statements to help compare our business to how other businesses are doing in the industry. The story that the financial statements tell helps us see, hey, how is it that our story compares to the story of X, Y, and Z competitor or X, Y, and Z business? And what are the things that we're doing well in comparison to those other businesses? And what are maybe things that we may be able to improve in order to generate greater success? So let's talk a little bit more about what are some of the benefits and importance of the financial statements. Well, obviously, basic tool for determining how well the operation is performing at all times. So the goal here is to look at our financial statements all the time. Maybe not every day, maybe not every week, but maybe every couple of weeks, and definitely at the end of the month, definitely at the end of the quarter, and obviously most definitely at the end of the year. The value of looking at the financial statements goes well beyond, if you want to get a loan or for the purposes of filing your tax returns and seeing if there's any tax liability. Owners and managers of a small business need to use financial statements in order to evaluate how is it that the business did this month versus last month, right? So what has changed, and has that been positive or negative? Then once I evaluate, then I need to diagnose any existing financial problems and forecast future trends in the firm's financial position. So once I evaluate, I diagnose what are the things that went well, what are the things that are not looking so well, and then finally, how can I predict, project, forecast future trends for our business? So when we think about evaluation, pinpoints where the firm has been and where it is today. When we think about diagnosis, we are looking at what are the problems that we see in the financial statements, and then what are potential solutions that we can pursue. So the regular preparation, the regular evaluation of the statements helps me as the manager, as the owner of the business, detect the problems. Now, one thing that we often get confused about is that the accountant or the CPA that is preparing these statements is going to provide us with the answers as to, well, what's wrong and how do I fix it? And the reality of it is that the accountant's expertise is only on preparing the forms. They can tell us what's wrong, but they may not be able to specifically suggest what are the kinds of steps that we should take in order to improve that particular item in the financial statement. So some of the problems that are detected through financial statement analysis and often tend to cause financial or failure of the small business is very high operating expenses. So when we look at operating expenses, but those are higher than the revenue we're generating, that's usually a problem. When we are, and this could tie into the next bullet point there, which is sluggish sales. Are sales not sufficient to generate to cover the operating expenses? So many a times the challenge is poor cash management. The failure to understand that there's inflows and outflows of cash, and that the timing of those inflows and outflows may create a cash crunch, which may put the business in a financial situation that it cannot overcome. And then lastly, excessive fixed assets and inventory mismanagement. So for a business that is carrying inventory, for a business that is has to have a lot of equipment, if you have too much, it may have a negative impact on the business financial condition. If you have too little, it may also, and the same with inventory. So keeping an eye on those numbers on the financial statements also becomes critical. So by comparing statements from different time periods, you can then begin to notice, are there any trends? Is it that my business is somewhat cyclical? So between January and March, sales decline, and therefore I need to have lower inventory levels to reflect the less sales I'm going to generate? Is it that there seems to be pricing increases that other competitors are taking advantage of and that I am not, and therefore I'm leaving opportunity on the table? All these are things that as a small business owner, as an entrepreneur, you're going to have to be keeping an eye on and understanding what is the impact on my business before those problems become large ones and ones that we really don't or can't manage. So the purpose of financial statement analysis is to utilize those statements as management tools that have to be prepared at least once a quarter. As I said, whether you prepare them once a month, I think once a month is appropriate, but most definitely take a look at your financial statements and do an analysis of them at least once a quarter and understand what kinds of issues is the business dealing with financially and what kinds of decisions do I need to make in order to help the business kind of move in the right direction. So how do I go about analyzing financial statements? Well, there's multiple ways. There's vertical analysis, there's ratio analysis, there's break-even analysis, there's measuring growth analysis, and there's revenue analysis. Now, each one of these is going to you, particularly to those of us actually, who are not CPAs, who are not accountants by training, who don't love accounting in any way, shape, or form, we are going to be like, what the heck is all this information, right? So I'm giving you kind of the behind the scenes look, because unless you understand the behind the scenes look, you're not going to be able to necessarily know what the numbers tell you. So the behind the scenes look, what I mean by that is that usually that's something that the CPA you hire, the accountant you hire, the person that is doing your financial statements, preparing them, is going to be able to provide to you. So you are not going to necessarily have to provide and create the formulas and figure it all out. What you're going to have to be able to do is understand, what does this mean? And what decisions do I need to make for my business based on this information? So let's start out by talking about vertical analysis. Vertical analysis is usually done on the income statement. We also refer to it in accounting as the common size analysis. And what it is basically the process of using a single variable on a financial statement as a constant and then determining how all of the other variables in that financial statement relate as a percentage of the single variable. So when conducting an income statement analysis, the constant variable is usually net sales or total revenues. That is going to be the constant. So the vertical analysis of the income statement would be used to determine specifically how much of a company's net sales or total revenue is being consumed by each individual entry on the income statement. So how much is rent taking up of the total sales I generated, right? How much are utilities taking up of my total sales? How much is marketing taking up of my total sales? And the reason why you would want to know that is because, again, if my sales for some reason are declining, then I have to evaluate, are my expenses, right, associated with generating that sale in alignment? And if they're not, then what do I need to change? So the formula for that you would normally use for a vertical analysis as a percentage of sales in the income statement is income statement account in dollars divided by net sales in dollars, and then multiplied by 100. And we're going to look at an example in a minute. So vertical analysis can also help in pricing a product because a pattern or relationship exists between net sales, percentage of overhead or operating cost, and profitability. Businesses generally, by way of the vertical analysis over time, can determine if that relationship is correct. So, if the total operating cost for the business is 47% of net sales, and operating income is 19% of total income, then what that tells me, or what I can use the vertical analysis for, is to determine what are the markup percentage, market requirements that I should have as a percentage of sales. So let's take a look at an example in our next slide. So to find the percentage of any item on your income statement, you would divide the total amount of that item by the total amount of net sales. For example, net sales for last month equal 150,000, rent was 3,000. We would just simply divide 3,000 by 150,000, multiply that by 100 to get a percentage amount. And what that tells us is that rent was 2% of the total net sales, right? So the total net sales or total revenues for last month. So again, what do we use the vertical analysis for? So to compare operating expenses and profit margin to other businesses in the industry. You can always gain good information into how is my business measuring up in comparison to industry standards. There's certain industry standards that we know have to be met when a business is operating. So for example, it may be really difficult to operate a successful restaurant if your food costs are much higher than 30% of net sales, or if your labor costs, direct costs, are more than 35% of net sales. Together, this make up what's called as prime cost. And this figure is the figure that we want to stay under in order to ensure that we have a profitable restaurant. If at any point you're running a restaurant and your numbers in these categories, food cost and labor cost, are higher than the ones that the industry average is showing, then I need to take a look at each one of those categories and understand how can I potentially change that, because the problem is going to be that I'm not going to be able to generate a profit if I'm not operating successfully and consistently, if I'm not operating below those numbers. So that is one of the reasons why we want to understand and we want to do vertical analysis. Another reason is, as I was saying, to price our products and services more accurately. So if you operate a retail store, for example, and you see on your annual income statement that your combined operating expenses, which includes your administrative, your marketing, your overhead, total 35% of net sales, and your operating income was 20%, how would you go about pricing a new product that costs you $30 to buy at wholesale based on that information? So in this case, you would use the pricing formula, which when we look at that pricing formula, it's expressed as revenue equals cost of goods sold divided by 1 minus gross profit desired. So in our example from before, we know that our cost of goods sold is $30. That's how much it costs us to buy the product wholesale. We know that the gross profit desired is 55% because I have a 20% cost associated with my sales and operating income. And then I have a 35% cost associated with my administrative, marketing, and overhead expenses. So that's a total of 55% gross profit I must have. So 1 minus 55 equals 45%. So in order for me to generate the desired gross profit, I have to mark the product up at around 122%. And what that 122% means then is that I have to price my product at $67 in order to generate the gross profit desired that I'm looking for. So again, I wouldn't know all this information necessarily if I didn't have or had conducted a vertical analysis. And again, my accountant, my CPA is not going to conduct these analysis for me. They're going to give me the data and they're going to allow me, the business owner, to make the decision on what is the best approach for this particular, for me to make decisions based on. So again, it's a good opportunity to make decisions or compare different expenses and cost ratios to one another. So comparing different expense ratios allows you to direct cost savings efforts where it will have the most impact. So for example, let's suppose that you've been spending a lot of time trying to cut back on one expense, such as insurance, right? Through your vertical analysis, you find out that that insurance expense signifies about 2% of your net sales. But your electricity expense signifies 15%, or takes, electricity and gas are 15% of your net sales. So in this case, maybe you're not really investing your resources in terms of trying to figure out how to lower the cost on the one that is going to yield a better result. Right? The insurance, you can get a much lower cost, but at 2% of total sales, it's not going to have that much of an impact. Whereas if you can negotiate better rates for electricity or your gas rates, you can moderate the consumption of those two items. Now at 15%, the impact that that's going to have could be significantly more. To quickly spot trouble areas so you can investigate what is going wrong and why. So let's say that you identify a certain cost that has skyrocketed in recent months. It may be a sign that theft or fraud is happening, right? And either within your business or from one of your vendors. So dollar amounts can be deceptive at times. We see, well, it's gone from 3,000 to 4,000. It's gone from 10,000 to 15,000. And so we don't, okay, well, maybe that month we spent a little bit more or something unusual happened. And that very well could be it. But when you look at it from a vertical analysis perspective, it will show discrepancies very quickly. So when an expense jumps from a 4% average, right, month after month, this expense is equated 4% of my total sales to 7.8% of my total sales, that all of a sudden is going to catch my eye, right? Because it's now something, wow, it is almost double. How is that possible? What happened? I want to understand. I want to see. So it's really important to, it's another benefit to doing the vertical analysis. So vertical analysis can offer a significant view, a different view, a different perspective of the financial health of the business that just looking at the financial statements may not provide, and allows me to dig deeper to make better, more accurate decisions that will benefit my business. All right. So now we're going to move on to ratio analysis. And ratio analysis is another way in which we can evaluate the health of our business. So a ratio is nothing more than a relationship between two variables that are expressed as a fraction. So please do not get too caught up in all the formulas I'm going to introduce to you in this lesson. Know that depending on your business, you would have different types of ratios that matter to you. Not all of these may matter to you. For some businesses, all of them will matter. For other businesses, only one or two of these will matter. The key is to identify which are the ones that matter, which are the ones that I should be looking at on a regular basis and understanding what is the impact in my business that this particular ratio speaks to. It is also another way, ratio analysis is another way to compare our business to other businesses in the same industry. And many a times when you do prepare your business plan, for example, we use a software called LifePlan, and LifePlan allows us to see information on benchmarking. And benchmarking primarily, many a times, is done through the introduction of ratio analysis. Normally, when we want to understand how our firm is doing in relationship to other firms in our own industry, ratio analysis is what we use, especially as the business compares with other firms in the same industry or similar industries. So the ratio analysis allows us to understand how healthy the business really is. So it's one of the most important financial tools you can use to proactively understand and operate and make decisions for your business. Now, there are an array of categories, and the textbook shows that, and so it's something that you should kind of read in more detail in the textbook, but I'm going to go through it here a little bit quick. So let's start out discussing profitability ratios. Profitability ratios measure earning potential. The first one that you see there, and the first one's discussed, I think, in the textbook, is gross margin percentage, which measures gross profit margin that the business is achieving on the sales it's generating. So the formula for that is sales or revenues minus cost of goods sold, which is gross profit, divided by sales or revenue. So it is used to determine how much gross profit is generated by each dollar of net sales. And the calculation tends to be pretty simple, but it gives us a really quick snapshot of how well are we converting sales and utilizing or the how much gross profit are we generating for each dollar of sales. Return on equity measures the return on invested capital. So this one is, again, if I have an investor or if I want to know how well is my investment doing, then it's just looking at what was the net income for the business versus how much was invested by the investors, by me, right, and the owner's equity. We're looking at two different accounts from two different financial statements. One is in the income statement, or the profit and loss statement, and one is on the balance sheet. The next profitability ratio is net operating income, which measures income generated from operations without looking at interest or without looking at taxes. Okay, so those are the two that we're kind of leaving out. So the formula is sales or revenue minus operating expenses that do not include interest. And again, we divide it by sales or revenue. And so here I'm just looking to see how well did I generate income in relationship to the expenses that I had to incur to generate that income, but not taking into consideration the cost of interest, nor taking into consideration the cost of taxes. Okay, So again, it gives me another preview into how profitable is this business. So when we look at an example I give you here on slide number 14, you see widget manufacturing company income statement section needed for calculating its gross. Sales from widgets, total sales, total revenues was 112,500. 85,040 was its cost of goods sold. Its gross margin then becomes 27,460. If I want to know what the gross profit margin is, then I'm going to divide, or I'm going to subtract the 8504 from my net sales, and then divide it again by net sales. This tells me that 0.24 is my gross profit margin. So what does that mean? Well, that means that 24 cents were made for every dollar generated in sales. So after I paid for the cost of generating those goods or selling those goods, or what it cost me to provide that service, I was able to generate 24 cents of gross profit for every dollar that was sold. So $76 or 76 cents, I'm sorry, is what it cost me to generate a dollar worth of sales. That's another way of looking at it. It's costing me $76 to generate a dollar worth of sales, because it's costing me, I have to pay $76 to pay for the products, to pay for the hourly rate, to pay for the not necessarily salary, but the direct cost potentially of providing the service. So if I was running a massage business, then the cost of services sold would be the hourly rate that I have to pay the masseuse, would be the supplies that the masseurs need. So the lotion maybe that they use to provide the massage, the towels that allow you to clean the water that is given to each client. Those, and their cost of goods sold, because they're going to vary directly with every sale. So if this was the example here, I generated 112,500 in sales, 84,000 is what it cost me, then it's costing me 76 cents per dollar to pay the products that I sell, and 24 cents then remains with the company to pay for the remaining of my expenses, which we categorize, as we talked about in the previous lesson, under operating expenses. There's also income tax, there's potentially going to be interest, there's potentially going to be dividends. So whatever else I have to pay out, I have 24 cents of every dollar to do so. So the higher the gross profit margin, the more stable the business is considered. And moreover, the higher gross profit margin indicates the company is making more money from each sale. Right? So the higher my difference is, so let's say that instead of 24 cents, it was 50 cents, that would be the gross profit margin, then I'm making 50 cents on every dollar of sales that I generate. And therefore, I have more flexibility, more money available to me to cover the other expenses that the business generates. And hopefully after I cover all those, then I have profit numbers that I can show. So again, when I look at the gross margin analysis, gross margins tend to be relative. Oftentimes students will ask me, well, what's a good gross margin number? It will depend based on the industry. It's a very, very, very broad general rule of thumb. 35% and above is considered a very good, and I mean very, very good gross profit margin. Good gross margins can give the small businesses a breathing room. So as you can see, if we go from 24 cents for every dollar to 50 cents on every dollar to maybe 75 cents on every dollar, now I have a lot of breathing room and I have a little bit less worries because I know that I am generating sufficient gross profit margins after I pay for my cost of goods sold or my cost of service sold to pay for my other expenses. And again, hopefully keep some of that money at the end after I pay interest and taxes and dividends and so on and so forth. It is also a good way in which to understand how to price my products. Why? Because I am going to, again, kind of work backwards. I'm going to try and figure out, well, what is the profit margin that I want, just like we did in that explanation I gave before, and then be able to kind of back it up into what is the right pricing for my product. It is important that as a small business owner, we plan for gross margin by being super focused on labor cost, material cost. So again, if I use the example of the massage business, I gotta be really focused on what is it costing me in terms of the labor I'm paying each individual employee, each individual masseuse, and then how much is the supplies that they're using costing me, because those are going to be the most common cost of goods sold for that type of business. And then identifying opportunities for price increases through differentiation, through creating perceived value add from the consumer's perspective, right? So pricing is important because that's what gives you the flexibility to generate the income. Compared with an industry average, a lower profit margin could indicate that the company is not pricing its products right. A higher gross profit indicates that the company is able to generate a reasonable profit on sales as long as it keeps overhead under control. So if you think about it long term, the investors, people that are eventually going to invest in your business, or maybe even people that at some point you may want to sell the business when we talk about valuation, people are going to pay more, invest more money on a company that's generating higher gross profit margins than one that has lower gross profit margin, and the same with a business when it comes to sell the business. So net profit margin is another category of profitability ratios, and this represents the percentage of profit from business operations after we've deducted operating expenses, we've deducted interest, we've deducted taxes. So the formula, again, pretty simple: net profit or net income divided by sales or revenue, right? So this tells us, again, how much has the firm, the business, earned on each dollar of sales after it pays for all its obligations, including interest and taxes, right? So this one, again, it's another one that tells us a story about the business. The gross profit margin is after gross profit, how much are we generating in income from sales? This one is really telling us, after we pay all of our obligations, how much are we generating from sales? So when you look at the net profit margin ratio, you see that the numerator is net income, which is affected by the company's actions to reduce expenses. And the denominator is net sales, which is affected by the company's actions to increase sales revenue. Both actions will impact the net profit margin ratio. So it tells us how well is the business converting its sales into profits, and how its expenses relate with those other similar companies. It's both a measure of efficiency and an overall measure of business health. Companies that generate greater profit per dollar of sales are more efficient. Companies with high net profit margin ratios are also better able to survive a product line that doesn't meet the expectations of the consumer, or if there's a period of economic anxiety or there's a contraction, meaning that the economy slows down. So again, this is also why it's important to understand what are the numbers telling us beyond am I making a profit or not, right? This is beyond understanding this is how much I own, this is how much I owe, versus this is how much I have generated in income or net income after all expenses are paid, right? This is allowing me to evaluate, as I said at the beginning of the lesson conversation, evaluate where do we stand, diagnose what are we doing well or not so well in the profitability world for this business, and then forecast what do I need to take into consideration in the future and what numbers should I or could I expect to generate as a business. In general, net margins of 5% and above are considered very good. And what do we base this on? Well, consider that the average profit margins of the 500 largest businesses in the United States since 1995 had ranged between 5.5% and 7.5%. And these are Fortune 500 companies, companies that are huge in size and are, growing and expanding and evolving and all that, acquiring other businesses and so on and so forth. And they're an average between 5.5 and 7.5 net margins. So if a small business is at 5 or above, you are rocking and rolling and really on your way to great success. The challenge of net margin is that it's usually understates net income and is usually a manipulated number in a variety of businesses. Another challenge is that the net earnings figure does not tell you where the earnings came from. Did the earnings come from operations, the product sales or services? Did the earnings come from investments, which sometimes the businesses do? If that net earnings figure is coming primarily from operations, then the business is sound. And by the way, most small businesses it's going to come from operations. It's the sales of the products or services, because although you may be investing in other businesses, you would have to achieve a certain size in order to have gotten there. So more than likely, if you are at 5%, and its majority, 99%, is coming from operations, the earnings are coming from operations, the business is pretty sound at that point. So let's move on to liquidity ratios. And liquidity ratios indicate the ability of the business to pay short-term liabilities when they come due, right? So the first one, and the one that you'll often hear people talk about in terms of debt is current ratio. So it just pretty simply measures whether current bills can be paid. Usually banks, lending institutions, investors like to have, your CPA likes to have a 2-to-1 ratio, meaning that for every dollar of liability, you have $2 of assets to cover that liability, or current assets, not just any assets, but current assets. So a higher current ratio, it's always more favorable. So if you're talking about a 3-to-1, a 5-to-1, man, CPAs, investors, banks, super happy with you. Anything below 2, they begin to show concern, although some will be okay depending on the industry, depending on the business, with a 1-to-1 ratio. But again, the higher the ratio, the better they're going to be able to feel confident that you're going to be able, if you get in trouble, to pay your liabilities with your current assets. So again, if the current ratio for a business is 4, that would mean the company has 4 times more current assets than current liabilities. So therefore, the likelihood of them paying their debt for their liabilities with current assets is pretty high. So here I give you an example, and I'm going to spend a little bit of time here, but not too much. Charlie's current ratio is 0.25. Not very good. That's all I can say. He only has 25% of his current liabilities would be paid off with the current assets he has. So he is highly leveraged. What we call highly leveraged is high debt, right? And therefore, this business, for anyone looking at it, is highly risky. So again, banks, lending institution, investors prefer a ratio, your accountant prefer a ratio of 1 or 2-to-1. so that all the current liabilities could be covered by the current assets. Charlie's ratio is way too low, so it is unlikely that any investor or a lending institution is going to pay much attention to him. All right, let's move on to our next liquidity ratio, which is the quick ratio. This particular ratio is also known as the acid test ratio. It basically assesses whether current bills can be paid without you having to sell inventory or any other liquid current asset. So a 1-to-1 ratio minimum is the target. The formula, again, is current assets minus inventory divided by current liabilities. So if a business that has a ratio of 1 indicates that quick assets equals their current liabilities. This also shows that the companies could pay off its current liabilities without selling any long-term assets or having to dip into its inventory or sell that inventory. An asset ratio of 2 shows that the company has twice as many liquid assets as current liabilities, and therefore it's even more favorable. So let's look at an example. Let's assume Carol's clothing store is applying for a loan to remodel the storefront. The bank asks Carol for a balance sheet because that is where we find our current assets and our current liabilities. And they ask her too, in order to look and see what is her quick ratio. So her balance sheet includes the following accounts, as you can see there. So the bank is able to compute that quick ratio or do an asset test ratio by looking at the fact that cash equals 10,000, accounts receivables are 5,000. Remember, we don't include inventories because on a quick or asset test ratio, inventory is not part of it. Stock investments would be, so that's $1,000. And that tells us that $16,000 of current assets minus inventory. Current liabilities are $15,000. What this means is that Carol's clothing store has an asset test ratio or a current ratio, quick ratio of 1.07. This tells us that she is able to meet all of her current liabilities with her liquid assets, which again, it's a positive thing. It's something that would be good. Even if you're not looking for a loan, even if, let's say that you're Carol, but you're not looking for a loan, it would be important for you to know, are my liabilities meeting the quick ratio test or the asset test ratio? Because if your liabilities are greater than your quick or current assets minus inventory, you may have some challenges, or you may have to think about what would I be able to convert into assets, inventory, long-term assets, fixed assets, in order to pay for liabilities that become current. All right, so now we're going to switch from to leverage debt or debt ratios. And leverage, it's also known as debt. Ratios indicate what percentage of the business assets are financed with creditors' dollars. So how much of my assets as a business that the business has are financed with creditors' dollars. So the first ratio we look at, it's debt to equity ratio. And the debt to equity ratio indicates what percentage of a business assets is owned by creditors. So again, for every dollar of equity, how many dollars of debt does the business owe? So ideally, the ratio should be as low as possible. The formula in order to come up with the ratio is total liabilities divided by stockholders' equity. And again, both of these accounts are found on the balance sheet. So I would know what my total liabilities are. I would know by my stockholders' equity or my owner's equity would be both accounts found in the balance sheet. A debt ratio of 0.5 means that there are half as many liabilities than there is equity. In other words, the assets of the company are funded 2-to-1 by investors to creditors. Okay, so 0.5 means half as many liabilities are than there is equity. So 2-to-1 is the ratio that we would look at of owners' investments to debt owed to other creditors. So this means that investors own 66 cents of every dollar of company assets, while creditors would own 33.3 cents on the dollar of every assets. A debt to equity ratio of 1 would mean that investors and creditors have an equal stake on the company's assets, on the business assets. Okay? And again, important to know, because if those investors if the lenders or creditors come calling, do they own enough to potentially kick you out of your business? Right? Because now they own the majority of the assets, they may decide, well, we are going to use that to leverage ourselves into ownership, complete ownership of the business. And that's something that can potentially happen and that you need to be on the lookout for. Operating ratios reveal the cost per sales dollars of operating a business. Lower the operating ratio means that you're operating the business efficiently, particularly when the ratio is low in comparison to other businesses in the industry and benchmark businesses. So one of those is days payable. Days payable measures the speed at which the business pays its bills. So ideally, you should wait to pay the bills for as long as you can without affecting the product, service, or shipments from suppliers. So the calculation for days payables is accounts payables divided by cost of goods sold divided by 365, which is the number of days in a year. Okay? So again, what we're looking at here is accounts payables divided by cost of goods sold divided by 365 days in a year. Collection ratio measures the quality of the accounts receivables that the business has. It shows the average number of days that it takes for the business to collect on that money that is owed to the business by customers who have bought potentially on credit. Ideally, unlike payables, you pay payables as late as possible, not passing their due date, but as far into when they're due as possible. So if the terms are net 30, then you pay net 30. If they're net 60, you pay as closely to the 60th day as possible. With collection ratios, you want the opposite. You want to collect as quickly as possible from the customers. You want to collect what's due to you as quickly as possible. The calculation to determine collection ratio, it's accounts receivables divided by revenue or net sales divided by 365. Then there's inventory turns or inventory turnover ratio. And for businesses that own inventory, that inventory is a significant component. So if you run a business that sells clothing, a coffee shop, an antique shop, the inventory turns becomes important to you. Auto part shop, the inventory turnover becomes important to you because it tells you how quickly are you turning over that inventory, how quickly are you generating sales for those goods and services that you have, and how many times are you having to replenish that inventory over a period of time, which usually tends to be a year. So the calculation for inventory turns or inventory turnover is cost of goods sold divided by the average inventory outstanding. Another operating ratio, and again, this only matters if you have inventory as part of your business model. It's days inventory carried, and this measures the average amount of daily inventory the business is carrying. So inventory divided by cost of goods sold, which is divided by 365 days. Operating ratios tend to matter. I mean, most of us business owners are going to have payables. We're going to have collection, right? We're going to have accounts payables. We're going to have, well, not all of us will have collection, but many of us will have collections of accounts receivables. A lot of us may not have inventory turnover calculations to make or days inventory carried calculations to make. And this is what I said at the very beginning of the lesson. Some of these will matter to you, some of these will not. Cash flow ratios measures a company's cash position. Okay, so all of us need to be worried about our cash flow ratios. We need to understand these numbers. We need to know what story it's telling us, because cash is king, and we will talk much more about this when we get to the cash flow lesson, but it is really important that we know this information as a business owner. I would say that the successful business owners have a really good understanding of their cash flow ratios. So cash flow cycle is the first one, which measures the number of days it takes to convert inventory and receivables into cash. Again, not all of us will have inventory. Some of us will be service type businesses. So for us, it may be receivables that is important. For some of us, both receivables and inventory will be important, and for some of us, just inventory will be important. So you can see how you can tweak this formula to meet the needs of your business. If it's a service business, more than likely I'm going to have only receivables. If it's a a production business where I'm selling goods, and I also sell on credit, not credit cards, but on credit terms, then I'm going to need both. If I have a business where I don't sell on credit terms, then I'm only going to be focused on inventory. It's just going to depend. And then my division here is by the cost of goods sold. Cash flow debt coverage ratio measures whether a company can meet its debt service requirements. So a 1.25 to 1 ratio minimum should be targeted. So here the formula is earnings before interest, taxes, and amortization divided by interest plus principal due on debt. Again, what I'm trying to figure out here is, can I meet my debt servicing requirements, right? So I'm looking at my earnings before I pay taxes, before I pay interest, before I pay dividends, before I pay amortization, divided by my interest expense and the principal that is due on that debt. Okay. So again, understanding what will it take if I need cash. So let's take a look at an example here. Suppose XYZ company is seeking out a loan to build a new manufacturing plant. The lender needs to review the company's financial statements to determine XYZ's and company's credit worthiness and ability to repay that loan. So one of the measurements that the bank is going to look at is the company's coverage ratio. So to calculate the review the statement of cash flows and find last year's operating cash flow total $80 million. Total debt payable for the year was $38 million. The statement of cash flow shows EBITDA of $64 million, depreciation of $4 million, and amortization of $8 million. So the cash flow coverage ratio would be 64,000 plus 4,000 plus 8,000 divided by 38. Did I say 1,000? Oh, should have been million. Divided by 38 million, which equals a 2, a covered cash flow coverage ratio of 2. The credit analyst sees the company is able to generate twice as much cash flow that what is needed to cover the potential obligations, the existing obligations that it has. And so depending on that particular financial institution's lending guidelines, they may or may not meet the loan's requirements, but this is the way that they're going to analyze it, and they're going to try and identify, do they meet our lending requirements or not? Cash flow coverage ratio does a good job of illustrating that if a temporary slowdown happens in earnings, current obligations would still be met and the business could make it through an economic slowdown, a mini recession, a lack of availability of a particular product, a variety of things that could happen to a business, whether it's self-inflicted or outside of their control, although recognizing that this could be for a short time. As with other financial calculations, some industries will operate with a higher requirement or a lower requirement for debt, which will affect this particular ratio. And so that's what is important, to use it as a benchmark. Understand what is it that my industry operates in this particular cash flow ratio, coverage ratio. In the scenario that I was just given, the bank would want to run the calculation again, now with the presumed loan that they're going to issue to them, to see now what is their coverage ratio, right? And could they handle that additional load of debt that they have? Too much of a decrease in coverage ratio with the new debt would signal that there's too much risk and the bank may not provide the loan because there is the possibility of late payments or the possibility of a default on that particular loan. Finally, let's talk about valuation ratios, which measures return to the investment made by investors. So price earnings ratio, PE ratio, we call it for short. If you have worked for a private company, not a private company, but for a company that is publicly held, and you may owe stock on that business, or you may hear financial analysts that brokers that sell 401k plans or IRAs talk about PE ratios of different stocks. What they mean is the price that investors are willing to pay for a company's stock based on the company's earnings. So it's the price of stock divided by the earnings per share. So for example, a PE ratio of 8 means that the investors are willing to pay $8 for every dollar of a company's earnings. Okay, so again, it just measures what is the return. I'm willing to pay $8 for every dollar that the company earns on this stock. And there's one way also that we will look when we look at valuation. In a few lessons, in a future lessons, we talk about the valuation methods, and this could be one of those methods to evaluate the value, to determine the value of the business. So why do we spend so much time talking about ratio analysis, and why do we use ratio analysis? Well, I feel like a little bit of a broken record, but I think it's important to reinforce these concepts. Number one is to quickly spot trends within the company across time, right? Trend analysis, identify the good, the bad, and the ugly, and adjust the business accordingly. So we evaluate, we diagnose, we forecast. The same reasons that we talked about in financial statement analysis, right, at the beginning. We also are able to answer better questions. Is my performance better today than it was a month ago, than a quarter ago, than a month, than a year ago, right? Am I progressing and making improvements as a business, or am I digressing and not making improvements, and which could signal the end of the business quicker than I expected? It also allows us the opportunity to identify ways to get better. Where are the areas where my energy and time should be spent? What should I focus on, right? Should I focus on debt? Should I focus on pricing? Should I focus on sales volume, right? Where do I focus my energy? And then when I try things, it also will serve me to kind of say, did that work? Did that make an improvement in that area that I was trying to improve in the financial statements, or did it not make any difference? And now I have to try a different area that may have the impact that I'm seeking. Again, to do external comparisons with other businesses in the same industry. So you can also see how ratios stack up against other businesses, both within our industry and outside of the industry. You should try to compare your ratios to the industry averages for the best and the worst performers and see where you fall, right? Are you falling amongst the best, or are you falling amongst the worst? Or you may have a mix depending on the different ratio that you were evaluating. When you seek external funding from a financial institution, or you want investors to invest in your business, you better understand ratio analysis, because that is one of the first things that the banks are going to do to determine whether or not you're credit worthy. It's going to look at your financials, and they're going to conduct these financial analysis, this ratio analysis. So you are best served by either doing it yourself or asking your CPA to do them for you, right? Because that will be really important. This will be the way in which most financial institutions make determinations as to whether or not you're credit worthy of additional line of credit, worthy of additional issuing credit cards for other business players within the business, etc. So really important from that perspective. To drive the future of the business, to see short-term and long-term, set short-term and long-term objectives. So for example, if you think that you want to grow revenues, this year was good, but next year you want to grow revenues by X%, right? While decreasing the level of inventory you carry. You got to understand the days of inventory carry must be reduced, right? And where are they today? Where do I want them to be next year? While the inventory turnover ratio is increased to some targeted numbers. So it seems counterintuitive, but it's really what those two numbers are working together, even though in opposite directions, to help you achieve your goal of higher sales, lower inventory. So again, if that's the goal, then ratio analysis offers the opportunity to help you reach that goal. So now let's talk a little bit about break-even analysis. So break-even analysis is the process of determining how many units of production must be sold, or how much revenue you must generate before you begin to make a profit, okay? The decision of whether to use units sold or revenues in order to calculate the break-even is based on a number of factors. So one of them was the firm's ability to determine a sales unit. So for a retail firm that deals in hundreds or perhaps thousands of individual items, if you're running a clothing boutique, you're going to have tops, you're going to have bottoms, you're going to have sweaters, you're going to have maybe shoes, jewelry, just an array of products. So the break-even point is sales dollars, right? In terms of sales dollars. So also if you're a service business, you're a massage MD type business, even a restaurant is going to be in terms of sales dollars. If you are a manufacturing business, then it's going to be calculated, break-even will be calculated in terms of units of production. Either way, we have to identify a variety of variables prior to determining the break-even point. So first we have to know the fixed costs, we have to know our variable costs, we have to know our sales, and again, either in total amount or per unit price. So let's look at our formula for total break-even sales. So if I'm looking at total, trying to figure out what is my total break-even sales, because I run a boutique clothing store, or I run a architecture firm or a massage business, then it's fixed expenses or fixed cost divided by my gross margin, which is price per service or price per unit per product minus variable costs. Variable costs are costs that vary with the number of sales that we have, or cost of goods sold also could be variable costs. So the number of units to sell, if I'm running a manufacturing operation where I'm manufacturing products, then it's total break-even sales divided by unit price. So I still have to calculate the total break-even sales, but then in order to figure out how many units I need to sell, then it's total break-even sales divided by unit price. So how much were my total sales do I have to have for break-even, and divide that by how much do I sell each unit, how much service. If I'm running a massage business, how much does each massage cost, right? And if I have 20 tiers of them, then I'm going to do an average of that. If I'm an architecture firm, how much does it cost for each service, right? And so again, I may do an average of that in order to identify what my numbers of how many architecture project engagements do I have to engage in, how many massages do I need to have scheduled each day or each week or each month to break even. Contribution margin is another way in which we can analyze the health of the business, and that is the amount of profit that will be made by a company on each unit that is sold above the break-even quantity, right? So how much profit will I make on each unit sold after the break-even point? So contribution margin is also the amount the company will lose for each unit of production, by which it falls short of the break-even point. So a small business should use contribution margin to understand how profitable each customer is to the business. So the formula for contribution margin is revenues minus variable cost. And here I'm going to include all my variable costs, right? So again, I'm going to look at what are those costs that vary with the production of a product or the providing of a service. They're directly tied to that. So if I'm an architecture firm, the cost directly associated with a project. Not the general administrative cost that it takes for me to answer the phone, to respond to customers' questions or concerns or inquiries, but once I have a project, what are the costs that is taking me, right? The printing, the drafting, the site visits, whatever it is, right? Are being associated with the cost of delivering that project, the results or the outcomes of that project. So let's look at a practice problem for break-even. And I'll let you read on your own. I don't need to read here. So the questions I'm asking is, how many dolls must be sold per month to break even? How many dollars in sales does this represent? And what is the contribution margin for each doll sold? So before we see the answers and walk through, I want you to take a few minutes to think through and work on this problem. All right, so let's take a look at the answers. My sales price per doll is $12. My variable cost, which could also be my cost of goods sold, are $4 per doll in raw materials and $2 per doll, and it takes 15 minutes per doll. Okay, it takes 15 minutes per doll. This is going to be important for the calculation. My fixed costs are salaries, insurance, rent, and utilities. right? So you may be saying, but wait a minute. Wait a minute. Something here just doesn't compute. No, everything is there. 2,500 is salaries, 1,200 is insurance, rent is 1,500 per month, and utilities 800 per month. It's all there. All right, so let's continue through the problem. Fixed cost per month, I hope this is the number you got, is $13,533 with 33 cents. How did I get that? Well, $2,500 is my salaries per week. There's 52 weeks in a year, 12 months. So in order to kind of average it out, because, it's hard to just do the 2,500 times 52 because some weeks we have some more weeks than others. Anyways, so we're going to do 2,500 times 52 divided by 12 plus 1,200 divided by 3. Why 1,200 divided by 3? Well, because we said that the insurance is 1,200 per quarter, not per month, but per quarter. So we have to divide it by 3. Plus 1,500, which it's the per month cost of rent, plus 800, which is the per month cost of utilities. So 10,833 in salaries, plus 400 in rent, in insurance, plus 1,500 in rent, plus 800 utilities gives me a total of 13,533.33. All right. Total variable cost per unit is the next number I need to figure out. And that is $6. Okay, Ms. Rainbow, how did you get to that? Well, I said raw material is $4. Labor cost is $2 per doll. How? Why? What? Well, it's $8 that I pay my employee per hour at this doll manufacturer. And they can complete 4 dolls in 1 hour. Why? Because each doll takes 15 minutes. There is 4 15-minute increments in an hour. So that means that is $8 divided by 4, which is $2. So my total variable cost per unit is $4 of material plus $2 of labor for a total of $6. So my break-even quantity then is 2,256 because we're going to round up. We can't really make 2,255.5 dolls. So we're going to round it up to 2,256. How do I arrive at that? Well, I took my fixed cost per month and divided it by the per dollar price minus the $6, which is the variable cost, for a total of 2,255.5. Again, I'm taking the fixed cost divided by my variable cost to arrive at the break-even quantity. How many quantities would I have to sell? How many dolls would I have to sell in order to break even? Break-even dollars then becomes, excuse me, the quantity times the price that I sell the dolls for. So my break-even quantity is 2,255.5 or 2,256 times $12 a doll for a total of 30,666.66. And then finally, what's my contribution margin? $6 per doll, just like my variable cost. Now, it's not always going to work that way, but in this case, it does, because the price of the unit, the per unit price is $12 per doll. My variable cost is $6 per doll. So my contribution margin is $6, or 50% of the sales price. Okay? Now, again, important analysis and information to perform. But I will tell you, in my experience, most accountants, most CPAs are not going to perform this calculation for you. They're going to assume that you're doing this for your products, and you're evaluating time and time again, which ones potentially you're willing to take a loss on because you're wanting to compete, even though your break-even analysis tells you that the pricing is not going to get you to the break-even dollars. Or that the break-even quantity is not going to get you to where you need to be. But you know that those products attract traffic in some sense, is some type of marketing and promotion activity, even though that's not what we call it in accounting, but that's what it would be, right? You're willing to sacrifice the contribution margin on those for the traffic that is generated. But then you're going to have others that are popular items that customers buy that are going to have to be priced at a break-even sales amount or above, because otherwise you're not going to be able to sustain the business for very long if you don't achieve that profitability. All right, so how do we measure business growth, financial growth in a business? Well, there's two opportunities or two types of formulas, I guess, that you could use to evaluate whether or not the business is moving in the right direction. Again, this continues our overall overarching discussion of financial statements analysis. So you can look at simple growth rate, the rate of growth relative only to the initial investment that was made or the original revenues of the business. Or you could look at it more comprehensively through the compounded annual growth rate, CAGR, which shows the interest rate compounded annually that must be achieved to grow the business from revenues in year one to revenues in future years. So simple growth rate focuses on present value, PV, and future value, future FV. Present value is the initial investment or the initial loan or the year one revenues of the business. And again, this is simple growth rate is a calculation that is done on any type of investment, whether you're going to take out a car loan, do savings accounts, invest in another business, invest in stocks, try to figure out what the growth rate should be for your business. So it's important that you understand this calculation. It's not one that you're going to be doing all the time. This is when we look at forecasting, this is where you're going to focus on this particular calculation, which is why we discuss it in this lesson. But nonetheless, it's as important as you prepare to move the business from year one to year two to year three to year four in understanding, what can I predict, what can I expect from the business. So giving you the formula, dollars of growth, future value minus present value, divided by initial investment, present value, times time. So I'm giving you the example. In this example, 18% is the simple growth rate. And so a business initial investment of $3.885 million would expect to have year two revenues of $4.584 million. If the growth of it is 18%. And using the simple growth rate calculation, then year three revenues would be $5.283 million. And how do I arrive at that? It's the 4.584 million of year two plus 18% of that, 699,300. Okay? This is just a simple way to forecast. Again, when we talked about financial analysis, we talked about evaluating, diagnosing, and so vertical analysis helps us evaluate, ratio analysis helps us diagnose, break-even analysis and contribution margin help us diagnose as well as forecast, and the simple growth rate and compounded aggregate growth rate allows us to also forecast. When using the compounded annual growth rate, we're calculating earning interest not just on the initial investment, the present value, like we did with the simple growth rate, but also on the interest that is earned each year after that. The shortcoming of using CAGR is that it only considers the revenues earned in year one and the revenues earned in the final year of our calculation. It does not take into account actual growth rates from year to year over a period of time. And that could leave some money and some calculations on the table. So following the example that we did with the simple growth rate, right, with an 18%, let's say now that we've transitioned to compounded annual growth rate, 18% is the compounded annual growth rate. And year one revenues was 3.885 million. Then the future revenues would be as described in this table, right? Under the simple growth, you see how it was simply calculated. Under the compounded growth rate, we are looking at the growth that happens with the interest that is earned, right? And so that interest then is impacted. It impacts the amount of growth that we experience because now we're putting that interest as part of the potential earnings here. Challenge, however, is that two businesses that have the same year one and year five and 18% compounded growth may not have had the same trends in year two and year three and year four. And so even though you would think that they would look the same, they may not. They may have had different trends in those years, but they're not accounted for using the compounded annual growth rate. Because the compounded annual growth rate assumes the same potential growth. So that tends to skew the calculation and the forecasting a little bit. And again, you wouldn't have to worry about this very much unless you're working on forecasting growth. And again, this is something that your accountant, your CPA should more than be willing to help you with. All right, so lastly, we're going to talk about revenue analysis. So when conducting a revenue analysis for a business, you want to find answers to the following questions. What are the sales growth rates for the past few years? What is the trend in sales growth? Is it declining? Is it increasing? Why are the revenues increasing? Why are the revenues declining? So that I can replicate it if it's increasing. I can do more of that, or I can do less of whatever it is I'm doing that's causing the decline if I have control over it. And then what is the increase or decrease in revenue happening in the same way in the industry, right, to other parties in the industry? There may be very valid reasons why revenues are declining that have nothing to do with the soundness of your business, right? There could be economic conditions that are outside of your control. As I record this, we are having a partial government shutdown, so the businesses that support those government employees that work at entities, so your dry cleaners, your car wash, the Lyft driver, the coffee shop, the little kiosk market in the corner, all those businesses are in essence impacted by this government shutdown. It has nothing to do with how sound their business model is. It has to do with things that are completely external to the business, but nonetheless is causing the reduction in revenues. So as a business owner, when conducting the revenue analysis, we should understand that if revenues are growing because we have lowered the price of a product or service, your break even may not be there. You may not be profitable, right? So you've lowered the price, but unless you've increased the volume by a large quantity, you're not going to be able to break even. Revenues may be growing because competition may be leaving the market. So there may be a player in the market that has exited, either because maybe the product or service is in the declining or ending life cycle of that product, The product may be becoming obsolete. The cost of producing that product is exceeding the potential profit. Those are trends that you need to be aware of. If that is why your revenues are growing, then that's something that you need to understand, because it could potentially be you next that's having to exit the marketplace. So we've talked about the importance of doing financial statement analysis, that having the financial statements is not enough. You need to understand what story are those financial statements telling us about the business. We've discussed multiple ways in which you can conduct a financial statement analysis. Talked about vertical analysis or common size analysis. Talked about ratio analysis and what the ratio tell us and why it's important to conduct ratio analysis for your business. Talked about break-even analysis, how important it is to understand what are my break-even quantities, what are my break-even dollar amount, sales amounts. Talked about revenue analysis and how the things that I have to consider. And we also talked about compounded annual growth rate versus simple growth rate in order to measure growth. All of these are the reasons why you're taking this class. No, you're not taking this class for the joy of it. It may be torture, it may be difficult, it may be challenging. But learning is not intended to be easy. And running a business is not intended to be a walk in the park. It's challenging. It's a struggle. It's wearing multiple hats that I may have never worn or desire to put on, but that I have no choice but to find a way to put it on and wear it well. It is understanding that you're going from potentially being a specialist to being a generalist. And a generalist in areas that you have no knowledge, no strength, no desire to operate in. But that's what it's all about. You have to understand the financials of the business to be able to make sound business decisions that are going to move the business forward in the direction that you want for it to go, instead of backwards. You have to understand financials in order to validate if the business is doing as well as it can in comparison to other competitors and comparison to other businesses in the industry. You have to understand financials and financials analysis, because that is the only way that you're going to know how and what to do, or what and how to do the things that you need to do in order to make sure that you're generating the levels of income that you need to generate to pay all your bills for the business, and then to have some left over for you to live on and maybe do more than that. So although I know that this is a challenging subject, and trust me, they will continue to get a bit more challenging, it's an important one. It's one that you need to have near and dear to your heart, and recognize that it's not easy. It's not going to be easy. Learning is not easy. It is in our greatest moments of discomfort that we learn the most. So embrace that discomfort, embrace that recognition that learning is not easy, and just continue to plug along.